Picture this, January 28th, 2026. You check the financial news and see a headline that should make every American's blood run cold. US dollar hits 4-year low against major currencies. The dollar index, which measures the greenback against a basket of 6 major currencies, just dropped to 98.5. That's the lowest level since January 2022. But here's what they're not telling you. This isn't a market correction. This isn't temporary volatility. This is a controlled demolition disguised as a market move. In the past 18 months, the dollar has lost 8.2% of its value against the euro, 11.4% against the Swiss franc, and a staggering 14.7% against gold. Your purchasing power is evaporating in real time. That paycheck, that savings account, that retirement fund, all denominated in a currency that's being systematically devalued. And here's the paradox that should keep you up at night. The dollar is crashing while the Federal Reserve insists everything is fine. Inflation is supposedly under control. The economy is supposedly strong. GDP growth is positive. Unemployment is low. So why is the world's reserve currency in freefall? Before we dive into the 4 forces simultaneously destroying the dollar, forces that include Brics de-dollarization, the yen carry trade unwind, China's strategic currency war, and the possibility that Trump wants to intentionally crash the dollar to inflate away America's debt, hit that subscribe button and join the Wealth Forum. This is the currency crisis they're hiding in plain sight. It's free, unlike the cost you'll pay if you don't understand what's happening to your money. So here's the question that changes everything. Is the dollar crashing by accident, or is this exactly what someone wants? Stick with me. Let me show you what's happening and why the official explanations are lies. January 2024, the dollar index was sitting at 102.8. The Fed had just paused rate hikes after the most aggressive tightening cycle in 40 years. Conventional wisdom said the dollar would stay strong. Higher rates attract foreign capital. Higher rates make dollar-denominated assets more attractive. Basic economics. Instead, the dollar started falling. Slowly at first. 102.8 in January, 2C24, 101.3. By June, 99.7 by December. Then the decline accelerated. 98.5 by January 2026. That's a 4.2% decline against the basket of major currencies. But here's what the index doesn't show. The real carnage is happening in bilateral relationships. The dollar lost 14.7% against gold. It lost 12.3% against the Swiss franc. It lost 11.8% against the Singapore dollar. These aren't emerging market currencies. These are safe haven currencies. And they're all outperforming the supposed safe haven of the world, the US dollar. Here's the historical context you need. The last time the dollar experienced a sustained decline of this magnitude was to descent to 8, just before the financial crisis. Before that, 2001-2002, the dot-com crash. Before that, 1985-1987, the Plaza Accord period. Every major dollar decline in the past 40 years has either preceded or coincided with a major economic crisis. We're now 18 months into a sustained dollar decline, and the crisis hasn't fully manifested yet, but it's coming. Let me give you the analogy that explains this. Imagine you're holding a currency that's essentially an IOU from a government. That IOU says, this piece of paper is worth $1 worth of goods and services. But what happens when the government that issued the IOU is $36.5 trillion in debt, running $2.4 trillion annual deficits, and has no realistic plan to ever pay it back? What happens is the IOU loses credibility. And when an IOU loses credibility, its value declines. That's not economics. That's common sense. But the dollar's decline isn't just about debt. It's about 4 simultaneous forces, each one powerful enough to tank the currency on its own. Together, they're creating a perfect storm that's destroying the dollar's reserve currency status in real time. Force 1, Brics de-dollarization. Force 2, the yen carry trade unwind. Force 3, China's strategic currency war. Force 4, the Trump administration potentially orchestrating a controlled dollar devaluation to inflate away debt. Let's break down each one. Force 1, Brics de-dollarization is not a theory anymore. It's policy. It's infrastructure. It's happening right now. March 2025. The Brics nations, Brazil, Russia, India, China, South Africa, plus 28 additional countries, launched the unit. It's a trade settlement, currency-backed 40%, by physical gold. Within 6 months, $430 billion in bilateral trade, settled using the unit instead of dollars. By January 2026, that number hit $890 billion. Let me explain why this matters. For 50 years, if you wanted to buy oil, you needed dollars. If you wanted to buy commodities, you needed dollars. If you wanted to trade internationally, you needed dollars. This created structural demand for dollars. Countries had to hold dollar reserves. That demand allowed the US to run massive deficits because foreign nations needed to buy treasuries to get dollars. But the unit changes everything. If you can settle oil trades in a gold-backed currency, why hold dollars? If you can settle commodities in yuan or rupees, why hold treasuries? The structural demand that propped up the dollar for decades is evaporating, and the numbers prove it. China's treasury holdings dropped from $1.3 trillion in 2013 to $745 billion in January 2026. Japan's holdings fell from $115 trillion to $920 billion. Foreign official holdings of treasuries, as a percentage of total debt outstanding, hit a 20-year low of 23.4%. The world is actively reducing dollar exposure, and every percentage point of dollar demand that disappears is another percentage point of dollar value that evaporates. Force 2. The yen carry trade unwind is a ticking time bomb most people don't understand. Here's how it worked. For years, investors borrowed yen at near zero interest rates in Japan. They converted those yen to dollars. They invested those dollars in higher-yielding US assets, stocks, bonds, real estate. The interest rate differential created free money. Estimates suggest $4 trillion to $5 trillion was involved in this trade. That's trillion with a T. Every dollar borrowed required selling yen and buying dollars. That's selling pressure on yen and buying pressure on dollars artificially strengthened the dollar. But in March 2024, the Bank of Japan started raising rates for the first time in 17 years. By January 2026, Japanese rates hit 0.75%, still low by historical standards, but high enough to make the carry trade unprofitable. Now the trade is unwinding. Investors are selling dollar assets. They're converting dollars back to yen to repay yen-denominated loans. That creates selling pressure on dollars and buying pressure on yen. The yen strengthened from 152 per dollar in April 2024 to 138 per dollar in January 2026. That's a 9.2% yen appreciation. And every point of yen strength means dollar weakness. But here's the kicker. This unwind is just beginning. If even 20% of the $4 to $5 trillion carry trade unwinds, that's $800 billion to $1 trillion in dollar selling pressure. The dollar's decline so far is nothing compared to what's coming if this accelerates. Force 3. China's strategic currency war is the most sophisticated attack on the dollar in history. China isn't just reducing treasury holdings, they're building alternative infrastructure. The cross-border interbank payment system, CIPS, is China's alternative to SWIFT. It processed 13.4 trillion in transactions in 2025, up 47% from 2024. The digital yuan is being deployed in 26 countries for cross-border trade. 89 billion in trade settled using digital yuan in 2025. That's small now, but growing exponentially. China is signing bilateral currency swap agreements with 42 countries, allowing direct trade in yuan and local currencies, bypassing dollars entirely. Russia-China trade hit 240 billion in 2025, $0 used. India-Russia trade reached $65 billion, $0. Brazil-China trade exceeded 180 billion. Over 40% settled in yuan and reals, not dollars. This is death by 1,000 cuts. Each bilateral agreement reduces dollar demand by a few billion. But collectively, they're reducing demand by hundreds of billions annually. And here's China's strategic genius. They're not attacking the dollar directly. They're just offering alternatives. Better terms, more stability, no sanctions risk. Countries choose Chinese alternatives not because they hate America, but because it's in their economic interest. When your competitor offers better service at better prices, with no political strings attached, you lose customers. That's what's happening to the dollar. Force 4. Trump's intentional dollar devaluation is the most controversial theory, but the evidence is mounting. Trump has said publicly he wants a weaker dollar. In 2024 campaign speeches, he argued that a strong dollar hurts American manufacturing, makes exports expensive, makes imports cheap, destroys American jobs. But here's the deeper game. The US has $36.5 trillion in debt. Interest payments are $1.2 trillion annually. That's unsustainable. You can't grow your way out. You can't cut spending enough politically. You can't raise taxes enough without killing the economy. That leaves one option: inflate the debt away. Devalue the currency. If you devalue the dollar by 30%, you just reduce the real value of the debt by 11 trillion. Your debt burden drops from 123% of GDP to 86% of GDP. Problem solved. But you can't announce this. You can't say, we're intentionally destroying the dollar to reduce debt. That triggers panic, capital flight, hyperinflation. So you do it quietly. You implement policies that weaken the dollar while denying that's the goal. Trump's tariffs. They reduce foreign dollar earnings, reducing foreign demand for dollars. Trump's threats to NATO allies. They reduce confidence in US security guarantees, reducing demand for dollar-denominated assets. Trump's criticism of the Fed. It reduces central bank independence credibility, reducing dollar as safe haven. Each move taken individually seems random. Taken collectively, they're a coordinated strategy to weaken the dollar without admitting it. And the timeline is suspicious. Trump took office January 20th, 2025. By February 2025, the dollar started its steepest decline. Coincidence? Maybe. Or maybe this is exactly what was planned. Now let me show you the exact moment this went from currency weakness to currency crisis. December 18th, 2025, that's the day everything broke. The Federal Reserve announced they're cutting rates by 25 basis points despite inflation running at 3.8%, above their 2% target. The justification? Concerns about economic growth and global financial stability. Translation: the economy is weaker than they're admitting, and they're choosing inflation over recession. The market reacted immediately. The dollar dropped 1.3% in a single session. Gold jumped $47. Treasury yields spiked as foreign buyers disappeared. But that was just the trigger. The real crisis began 48 hours later. December 20th, 2025, Saudi Arabia announced they're accepting yuan for 30% of oil sales to China. This was rumored for months, but now it's official policy. The petrodollar, already weakened, took another body blow. Then December 23rd, 2025, China's central bank released data showing they added 187 tons of gold to reserves. In 2025, the largest annual increase in a decade. They're not buying dollars, they're buying gold. December 27, 2025. Japan's Ministry of Finance confirmed they sold $58 billion in treasuries in Q4 2025 to support the yen. The second largest foreign holder of US debt is dumping bonds. 4 consecutive announcements in 9 days, each one reducing dollar demand, each one accelerating the decline. By January 3rd, 2026, the dollar index hit 99.1. By January 15th, it was 98.7. By January 28, 98.5, a 4-year low. But it's not just the index, it's the velocity. The dollar lost 1.8% in January 2026 alone. That's the fastest monthly decline since March 2020. The COVID panic. And here's where it gets dangerous. Currency declines feed on themselves. When the dollar weakens, foreign holders of dollar assets see losses. They sell to avoid further losses. That selling accelerates the decline, which causes more losses, which triggers more selling. It's a feedback loop, and once it starts, it's incredibly difficult to stop without drastic action. The Fed is trapped. They can raise rates to defend the dollar, but that crashes the economy and blows up the government's interest costs. Or they can keep rates low to support growth, but that accelerates dollar decline and inflation. There's no good option. Only choices about which crisis you want to face first. And the market is starting to realize this. Bitcoin hit $108,000 in January 2026. Gold crossed Dallas 5,000. Real estate in major cities, up 14% year over year. Everything that's not dollars is rising because people are fleeing dollar-denominated assets. Then came the revelation that changed the narrative. January 19th, 2026, a leaked Treasury document revealed administration has been running economic models on beneficial dollar devaluation scenarios. The document outlined how a 25–30% dollar decline over 3 years would reduce debt to GDP, boost exports, and reshore manufacturing. It called this a strategic currency realignment rather than a devaluation. The leak was denied, called unauthorized analysis and not official policy, but the damage was done. The market now knows the administration has considered intentional dollar weakness. And if the government wants a weaker dollar, fighting it is futile. You can't beat the Federal Reserve and the Treasury Department in a currency war. They control the printing press. This is the moment where dollar weakness stopped being a market phenomenon and became a policy objective. And that changes everything. Now let's walk through what a crashing dollar means for you, your family, and your financial future. Consequence 1. Imported inflation accelerates. A weaker dollar makes imports more expensive. Oil, electronics, cars, clothes, anything made overseas costs more. The US imports $3.2 trillion in goods annually. A 10% dollar decline means $320 billion in additional costs passed to consumers. That's embedded inflation that can't be fixed by Fed policy. Consequence 2. Real wages collapse. Your salary might stay the same nominally, $50,000 a year. But if the dollar loses 20% of its value, that's really $40,000 in purchasing power. You're making the same number of dollars but affording less. This is how middle-class wealth gets destroyed silently. Consequence 3. Foreign investment dries up. If you're a foreign investor and the dollar is falling 8% annually, you need US assets to return 8% just to break even. If treasuries yield 4.3% and the dollar falls 8%, your real return is negative 3.7%. Why would anyone accept that? Foreign direct investment into the US dropped 23% in 2025. That's factories not built, jobs not created, growth not happening. Consequence 4. Debt becomes harder to service. The US owes $8.1 trillion to foreign creditors. If the dollar falls 30%, the debt costs 30% more in foreign currency terms. Countries that hold treasuries see massive losses. They'll demand higher yields to compensate for currency risk. Higher yields mean higher government borrowing costs, which means larger deficits, which means more currency pressure. It's a death spiral. Consequence 5. The reserve currency status erodes permanently. When the dollar was strong and stable, holding it made sense. When it's weak and falling, holding it is financial suicide. Central banks are already diversifying. Dollar share of global reserves hit 58% in 2025, down from 73% in 2001. If it drops below 50%, the dollar loses its privileged position. That means the US can no longer fund deficits by printing currency foreigners need. The game is over. Consequence 6. Asset bubbles pop simultaneously. When people flee the dollar, they buy assets. Stocks, real estate, crypto, gold. That creates bubbles. But eventually, the Fed is forced to raise rates to defend the currency. When they do, all those leveraged asset purchases collapse at once. Housing crash, stock crash, crypto crash, 2008 all over again, but worse. Consequence 7. Social and political instability rises. When people's savings are wiped out by inflation, they get angry. When they can't afford food and rent, they protest. When the government is seen as intentionally destroying the currency to pay off debt, trust in institutions collapses. This is how democracies fail. Economic crisis becomes political crisis, becomes social breakdown. Consequence 8. A new monetary order emerges. The dollar-based system is ending. What replaces it? Maybe the Brics unit becomes the new reserve currency. Maybe a basket of currencies. Maybe gold. Maybe digital currencies. But whatever it is, America won't control it, and American living standards will adjust downward to match the reality that we can't print our way to prosperity anymore. These consequences aren't hypothetical. They're unfolding right now in January 2026. You're living through the dollar's decline. In real time. The only question is whether you're positioned for it or being destroyed by it. So here's the brutal truth they don't want you to understand. The dollar is not crashing by accident. This is a controlled demolition dressed up as a market movement. Brics de-dollarization is real and accelerating. The yen carry trade unwind is draining liquidity from dollar markets. China is waging the most sophisticated currency war in history, and the Trump administration might be intentionally weakening the dollar to inflate away debt. 4 forces, all pushing in the same direction, all destroying dollar value simultaneously. And here's what you need to understand. These forces aren't going to reverse. Brics nations aren't going to abandon the unit and come crawling back to dollars. Japan isn't going to cut rates back to zero and restart the carry trade. China isn't going to stop building alternative payment systems. And if Trump wants a weaker dollar to reduce the debt burden, he's not going to change his mind. The structural forces driving dollar weakness are permanent. This isn't a dip to buy. This is a trend that will define the next decade. Every fiat currency in history has eventually failed. The average lifespan is 27 years. The dollar has been pure fiat since 1971. That's 55 years. It's lived twice as long as the average. Not because it's better managed, because it was the global reserve currency, because there was no alternative. But now there are alternatives. The Brics unit, gold, Bitcoin, bilateral currency arrangements. The infrastructure for a post-dollar world exists. Countries are using it. The transition has begun. The dollar's decline from 102.8 to 98.5 is just the start. If current trends continue, the dollar index could hit 90 by 2027. That represents another 9% decline from current levels. Combined with the decline since 2024, that's a total 12.5% loss in 3 years. But the real losses are in purchasing power. Gold is up 70% since 2024. Real estate up 28%. Stocks up 31% nominally, but flat in real terms. If you held cash or bonds denominated in dollars, you've been annihilated. And the people who saw this coming, the smart money, they positioned years ago. They bought gold when it was $1,800. They bought Bitcoin when it was $25,000. They diversified into foreign currencies and hard assets. Now those same people are sitting on 70%, 100%, 200% gains. Not because they were geniuses, because they understood the math. You can't run $2.4 trillion deficits forever. You can't monetize debt indefinitely. You can't weaponize the reserve currency without consequences. The dollar is paying the price for decades of fiscal irresponsibility and monetary recklessness. And American citizens who saved in dollars are paying the price with them. So what should you do? That's the question everyone's asking. And I can't give you financial advice, but I can tell you what the smart money is doing. They're holding no more than 20–30% of assets in dollar-denominated cash or bonds. They're holding 15 to 25% in precious metals, primarily gold and silver. They're holding 20–30% in hard assets like real estate and stable jurisdictions. They're holding 10–20% in international equities and currencies. They're holding 5–15% in Bitcoin and crypto as a high-risk hedge. The exact allocation varies by risk tolerance, but the principle is the same. Diversification across asset classes and currencies. Because holding 100% dollars when the dollar is in structural decline is financial suicide. The dollar at a 4-year low is not a buying opportunity. It's a warning signal. The question is whether you'll heed it. If this analysis showed you the real forces destroying the dollar that mainstream media won't explain, smash that like button, subscribe to the Wealth Forum, and turn on notifications so you understand every stage of this currency crisis as it unfolds. Now here's my question for you. What percentage of your wealth are you holding in dollars right now? Drop your number in the comments. Are you 100% dollars? 50%? 20%? Or have you already diversified into gold, crypto, foreign assets? Tell me your dollar exposure and your crisis preparation strategy. Are you worried about this dollar decline, or do you think it's overblown? I read every single comment. This community is preparing together. And remember, by the time the mainstream media admits there's a dollar crisis, it'll be too late to protect yourself. Premiums on gold will spike. Capital controls might be imposed. Your window to move assets will close. The smart money positioned 2 years ago. The aware money is positioning now. The unaware money will panic later and accept whatever terms they're given. Which category do you want to be in? Thanks for watching. Now go protect your wealth before the dollar's controlled. Demolition becomes an uncontrolled collapse, because the difference between those two scenarios is your financial survival.